Well, there's been a lot of talk lately about silver being on the edge of another run, and the reason people keep pointing to is a single report that drops every week and quietly tells you who's leaning where. So in this video, we're going to separate signal from story time, and you're going to walk away feeling a lot smarter and more confident the next time somebody says it's happening right now. It's Monday, February 16th. Not individual names, not secret villains, just buckets. It tells you how many contracts are open and how those contracts are distributed across groups that generally behave differently. That's it. But then people add a layer of mythology on top of it. They start treating it like a mood ring for the entire market. And the problem is, a mood ring can't tell you why the mood changed. So here's the first cliffhanger question. Are we looking at a genuine contrarian extreme, or are we looking at a normal unwind that just looks dramatic when you zoom in? Because those are two very different situations. Now, the big headline right now is this phrase, managed money longs evaporated. In plain English, the group that tends to chase trends has backed away, and the way that gets sold to you is when the hot money leaves, you're close to the bottom. Sometimes, not always. Sometimes hot money leaves because it's scared, and sometimes it leaves because it's bored. And sometimes it leaves because a risk model somewhere decided the ride wasn't worth the seatbelt anymore. So before you decide this is bullish, we have to ask a more specific question. Did the longs evaporate because price action broke them? Or did the longs evaporate because a different market became more attractive? If you don't ask that, you're guessing. And guessing feels a lot like analysis until the market proves you wrong. Now, people also keep bringing up a specific historical echo. They'll say, back in February of 2024, you had managed money leaning heavily bearish, something like around 40,000 contracts net short, and not long after that, silver pushed higher by roughly a quarter move. Okay, that's the past example. But here's the part that gets skipped. What does around 40,000 net short actually mean? Because if you don't understand what that number represents, you can't interpret it. So let's slow down, and I promise this is worth it. A net short number is not the same thing as there are 40,000 people short. It's not a vote count. It's more like a scoreboard difference. It's the shorts minus the longs inside that one bucket. You could get the same net short result in a bunch of different ways. A big short pile with a decent long pile, or a medium short pile with almost no longs, or a lot of gross activity on both sides that cancels out. And those situations behave differently. So when someone says net short, your follow-up should be, is it net short because shorts are huge or because longs are tiny? Because one can signal aggression and the other can signal apathy, and those are not the same trade. Now, here's where it gets even weirder. People will quote one number from that historical period, and then they'll quote a different number from a different week, like single-digit thousands net short, and they'll treat both as proof of the same thing, extreme. But extreme is not a single number. Extreme is relative to the whole distribution. Let me give you an analogy. Imagine you're looking at a coastline. At low tide, a rock looks huge, like it's dominating the beach. But at high tide, that same rock is barely visible. The rock didn't change. Your reference point changed. Positioning works the same way. If open interest is high, a net short number can be less meaningful than it looks. If open interest is low, the same number can represent a much bigger tilt. So the right way to think about it is not what's the net number, it's how stretched is that number relative to the market's normal range in this environment. And this is why two people can look at the same report and come away with opposite conclusions. They're not just reading data, they're reading data through a lens. Okay, so let's build that lens properly. The report breaks traders into groups, and the groups have different motives. You've got commercial participants. Think producers, users, refiners, merchants. They use futures like insurance. If they're short, it's often because they're locking in prices for future production or managing inventory risk. It's not a moral statement about silver. Then you've got the managed money crowd. Funds, advisors, systematic strategies, macro traders. They're not in there because they need the metal. They're in there because they want price exposure. Then you've got smaller traders below reporting thresholds. And then you've got the other bucket. So when people say the commercials are short, therefore manipulation, I want you to hear something different. I want you to hear the insurance buyers are buying insurance. Could there be gamesmanship in markets? Sure. But if you start with the assumption that every hedge is a conspiracy, you'll miss basic mechanics. Now, the contrarian thesis usually focuses on the managed money group because that group tends to chase what's already moving. And when that group gets too lopsided, it can become vulnerable. If price moves against them, they cover, and covering becomes fuel. That's the simple story. But here's the skeptical alternative interpretation that doesn't get clicks. Sometimes managed money is net short because the math changed, not because the crowd got emotional. For example, if real yields rise, the opportunity cost of holding non-yielding assets changes. If volatility jumps, risk models clamp down. If correlations shift, portfolio rebalancing forces flows that have nothing to do with belief about silver. So it might not be they hate silver. It might be the spreadsheet says reduce exposure. And if that's the driver, the reversal timing can be very different. Now let's talk about the Shanghai angle because it keeps popping up as the spark. You'll hear once Shanghai is back in full swing, all bets are off and silver could rip. Here's my challenge to that. A major market hub becoming more active can matter. Yes, it can change liquidity spreads and the way physical and paper markets talk to each other, but it's not a launch button. It's more like turning a set of valves in a plumbing system. Pressure shifts, flow routes change, and the places where stress shows up can move around. So, if you're waiting for a single open moment to flip everything, you're probably oversimplifying. And oversimplifying is how people get trapped. Now, there's another catch with this whole discussion. The report is delayed. It's a snapshot from earlier in the week, published later, and then interpreted even later. That doesn't make it worthless. It just means you have to treat it like a rear view mirror, not a windshield. And when you forget that, you start driving by looking behind you. That's not a strategy. Now, to see how this story took off, I did some digging. I went back through recent weeks of the report, not because I'm trying to play detective for fun, but because I wanted to understand why everyone is suddenly acting like this is a binary moment. And what I found is that most of the viral takes are built on a single comparison. This week looks like that week. That's it. No range, no context, just two dots and a line drawn between them. The problem is, markets don't live on two dots. They live on distributions. So I did something simple. I asked if you hide the labels, would this still look extreme? Because when you remove the story, you can actually see the shape. And here's what jumps out. The managed money bucket can swing dramatically week to week without the underlying physical market changing at all. That's not a conspiracy, that's leverage. Futures are a levered instrument, so participants can add and remove exposure fast. That means positioning can look like a heart monitor even when the patient is just walking upstairs. So when someone shows you one sharp drop in longs and says, "This is it," your response should be okay. But is that a trend change or just a risk reset? And this is where the time lag matters again, because by the time you're reacting to last Tuesday's snapshot, the market may already be somewhere else. Now, there's another misunderstanding that's almost identical to the one people make with open interest, and it comes from thinking the report is telling you the future. It's not. It's telling you who is holding what. That's why the best use of it is to measure pressure, not direction. Pressure is the probability that a move, once it starts, can accelerate. Direction is the assumption that the move must start. So when you hear managed money is net short, translate that into there is potential buy pressure sitting on the sidelines because shorts become buyers if they're forced to exit. But then add the second sentence. They only become buyers if price threatens them. That second sentence is everything because if price just drifts, those shorts can sit there. They can even add, they can roll, they can wait, and retail gets exhausted watching nothing happen. That's why the most dangerous trade is the trade you're right about too early. Now, let's talk about the word contrarian because it's getting abused. Contrarian doesn't mean you automatically do the opposite of what one group is doing. Contrarian means you recognize when a trade is crowded and you ask whether that crowd has enough room to keep being right. Sometimes the crowd is crowded and still right. Sometimes the crowd is crowded and trapped. Your job is to figure out which one you're looking at. And you don't figure that out by staring at the report harder. You figure it out by watching how price reacts to news and levels. If bad news keeps pushing silver down and it can't bounce, then the crowd may be right. If bad news stops working and silver refuses to break, that's when contrarian setups tend to matter. Now, let me add one more layer that most people miss. Classification is messy. These buckets are based on reporting categories, and while the broad behavior is consistent, it's not perfect. Strategies evolve. Entities change how they report. Exposure shifts between futures and options. A fund can hedge a futures position with options and look less long in futures even if their total exposure didn't change that much. So, when you see longs evaporated, it might be a true reduction or it might be a migration of exposure. And if you don't allow for that, you'll overread the signal. Okay, now zoom out with me for a second. From recent market updates, there are three big currents that keep sloshing through metals, and silver sits right in the middle of all three. The first is policy uncertainty. Traders keep trying to price the path of inflation, growth, and rates, and they keep getting new information that forces repricing. That creates volatility, and volatility changes positioning. Even if you don't care about macro, macro cares about you. The second current is the industrial build-out story. Energy grids, electronics demand, data infrastructure, and the push for efficiency all increase silver's relevance as an input. It doesn't mean demand is a straight line, but it does mean the floor under demand is more complex than it used to be. And the third current is trust. When people worry about deficits, about currency purchasing power, about geopolitical friction, they look at hard assets differently. Sometimes they run to cash first, and sometimes they run to metals. And silver often lags that first wave, then tries to catch up. It's like it waits for the room to decide what kind of party it is. And that brings us back to why the same positioning setup can lead to different outcomes. If the dominant current is tight money and strong dollar, silver can struggle even if speculators are short because the macro gravity is pulling down. If the dominant current is easing pressure and improving liquidity, silver can rip because you get both the macro tailwind and the positioning squeeze. So the report doesn't answer the question, it tells you what kind of fuel is in the tank if the engine catches. Now, I want to do a quick reality check on the historical rhyme everyone keeps repeating. Yes, there was a period where managed money was heavily tilted and then silver moved, but that doesn't automatically mean the tilt caused the move. It may have amplified it, it may have been along for the ride. It may have been reacting to the same macro inputs that pushed price. And this is where people get fooled by correlation. They see two things near each other and assume a straight line. Markets are not straight lines. They're a tangle of feedback loops. So rather than chasing the last rhyme, your goal should be to watch for the next feedback loop. If price starts pushing up, shorts cover. The covering pushes price more shorts cover, and suddenly you're in a cascade. That's a feedback loop. But if price pushes up and then stalls and positioning doesn't change much and the market fades, then you weren't in a loop. You were in noise. And that's why timing matters. So what do we do with a rear view mirror? We use it to see where we've been, not to predict every turn. So instead of saying the report guarantees a rally, the smarter move is to say the report suggests a crowded lean, and crowded leans can create opportunity if price starts to move and the crowd has to respond. That's the difference between analysis and prophecy. Okay, now let's rebuild the history rhymes claim the right way. If we assume for a moment that the contrarian red is correct, what would we expect to see next? We would expect price to firm up even while sentiment stays sour. We would expect the headlines to feel boring or negative while the tape quietly improves. We would expect dips to get bought a little faster. And then at some point, we'd expect a squeeze. Not because the world suddenly loves silver, but because the short side becomes crowded and the exits get narrow. That's how these moves usually feel in real time. They don't feel like fireworks at the start. They feel like confusion. Now, that's one path, but there's a second path that's just as plausible, and it's the one people avoid because it kills the vibe. What if silver chops sideways, the bullish positioning story stays in place for months, and nothing happens? That also happens. And here's why that can happen. So, if you want to use this data responsibly, you need to put it in context. Let's add some context that's not in the setup. And this is the part that matters right now. Silver sits at a crossroads between monetary metal and industrial input. That means it tends to care about two worlds at once: macro policy and real economy demand. When traders are obsessed with central bank messaging, metals can get yanked around by the bond market. When rate cut expectations swing, silver can whip. When the dollar strengthens, silver can feel heavier. When the dollar weakens, silver can breathe. And in recent market updates, we've seen that narrative flip back and forth more than people admit. One week its cuts are coming, the next week it's not so fast, and metals react accordingly. On the industrial side, silver is tied to electrification, power infrastructure, electronics, and solar manufacturing. When global manufacturing is expanding, that demand story feels supportive. When manufacturing is contracting, silver can trade like a risk asset that gets sold with everything else. So, if you're only watching positioning and ignoring macro, you're missing the steering wheel. Now there's also supply dynamics. A lot of silver comes as a byproduct of other mining. That means supply doesn't always respond quickly to higher prices the way people assume. If the primary drivers are decisions in other metals, silver supply can be stickier than expected. And when supply is sticky, pricing can jump when demand surprises. But that also means the market can stay tight even when price looks sleepy, which is why squeezes can happen. Now, there's another layer here. The way investors get exposure has changed over the years. Some flows go through futures, some go through funds, some go through physical products, and some go through structured trades. That means you can have a moment where the report says one thing, but the price is reacting to a different pipeline of demand. So don't assume the report is the whole market. It's a window, not the building. Okay, now one of the more interesting claims in the setup is that price can surge even as managed money longs are declining. And that is actually a useful concept because it reminds you buying pressure can come from somewhere else. Maybe it's commercial hedging behavior shifting. Maybe it's industrial demand showing up through a different channel. Maybe it's spread traders reallocating exposure. Or maybe it's just a temporary liquidity event. But it tells you not to assume the managed money crowd is the only driver. And that matters because if the next rally happens, it might not start with a clean, obvious positioning flip. It might start with the market moving and the positioning following. And that's another thing people get backwards. They think positioning causes price. Sometimes price causes positioning. Now, let's address the temptation that always shows up here. Dream targets. You'll hear people say silver could go north of some big round number, or even retest some wild level from a past mania phase. I get why that's exciting. It's easy to picture, but it's also the quickest way to get yourself into trouble because targets create tunnel vision. So instead of fixating on a destination, I want you to think about the route. What would a healthy rally look like? A healthy rally is one where the market grinds higher, pulls back, holds support, and then pushes again. It's annoying, it's slow, it makes everyone doubt it, and then it keeps going. What would an unhealthy rally look like? It's one where price goes vertical, headlines get euphoric, spreads get weird, and then the whole thing reverses faster than it went up. So if you're watching for the next move, don't just ask, is it going up? Ask, how is it going up? Because the how tells you whether it's sustainable or just a squeeze that will punish late buyers. Now, let's get even more practical. A lot of people look at this weekly report like it's a thermostat. They think if it reads cold, then heat is coming. But it's not a thermostat. It's more like a photograph. A photograph can tell you what the room looked like. It can't tell you whether someone just opened a window. So the real-time work has to come from price and from the broader market. That means if you want to build confidence, you watch for confirmation. You watch for higher lows. You watch for failed breakdowns. You watch for the kind of price action where bad news stops working, and you listen for the kind of macro tone where liquidity is improving instead of tightening. Now, I want to give you a second analogy because this one trips people up all the time. Open interest and positioning are not a pile of static bricks. They're a moving crowd. Contracts get opened, closed, rolled, hedged, rehedged. If you look at a single number and assume it's the same people holding the same trade, you'll misread the whole situation. It's like standing on a bridge over a highway and trying to guess the city's population by counting cars at one moment. You'll get a number, but it won't be what you think it is. So when someone treats a single week's positioning as destiny, they're confusing a flow with a stock. And that is exactly how people get overconfident. Okay, so what's a reasonable way to use this? Here's a framework that keeps you from getting hypnotized by one data point. Step 1. Treat the weekly positioning snapshot as a sentiment gauge, not a trigger. Step 2. Look for confirmation in price behavior. Is the market holding levels it used to lose? Is it reclaiming key areas and then building on them? Step 3. Watch macro pressure. Are real yields rising or falling? Is the dollar squeezing risk assets or loosening them? Is broader risk appetite improving or deteriorating? Step 4. Listen to the physical side without getting lost in hype. Based on recently published numbers, industrial demand narratives can shift quickly, but the real tell is whether the market starts paying up for immediacy, whether tightness shows up in spreads, and whether dips get met with real buying. And step 5, manage your own psychology, because the biggest danger in metals is not the market. It's you. It's you buying because you're scared of missing the move. It's you selling because you're scared of being wrong. It's you believing the story you want to be true. So yes, I like contrarian thinking. I like stepping in when sentiment is cold. But contrarian doesn't mean reckless. Contrarian means patient. It means you can be early and still be right, but you size it so early doesn't kill you. Now, the setup also included a practical reminder that I fully agree with. When you buy anything volatile, buy it with the expectation it can drop. If you buy expecting straight-up gains, you'll panic the first time it pulls back. If you buy expecting volatility, you'll be calmer when it shows up. And calm is a superpower in markets. So if you're accumulating, you should have a plan for dips, a plan for chop, and a plan for the possibility that your timing is off. And if you're trading, you should have defined risk, because silver can humble you fast. Now, I want to ask you something, and I really want you to answer in the comments. Do you actually watch positioning reports like this, or do you think they're mostly noise? And second question, what would have to happen for you to say, okay, the next leg is real, not just a bounce? Drop your answer below. And one more thing, because this matters. If you're successful, share your success story in the comments so others can stay motivated. People need to see what steady discipline looks like, not just highlight reels. Now, before we wrap, I want to zoom out and add a little more context that most silver videos skip entirely. Silver has this identity problem. Some days it trades like money. Some days it trades like an industrial metal with a turbo button. And the reason that's important is that the same positioning setup can behave differently depending on which identity the market is wearing. If investors are treating silver like a hedge against policy mistakes, then your catalyst list is things like inflation surprises, rate credibility, geopolitical stress, and confidence in institutions. If investors are treating silver like an industrial input, then your catalyst list is manufacturing cycles, energy build-out, electronics demand, and growth expectations. And lately, we've seen that tug-of-war more than usual. That's why you can get stretches where one metal feels calm and silver feels like it's bouncing off the walls. So, if you're trying to use one report as the answer, you're going to be frustrated because the answer changes with the regime. Now, let's bring it back to the original claim. Manage Money is positioned like it was in February of 2024. And that preceded a big rally, so we might be near another one. Here's my bottom line. The contrarian setup is plausible. The crowd may be leaning, the market may be primed, but that does not mean the move is scheduled. It means the conditions for a sharp move are present if the right spark shows up. And if you want to be the person who catches moves without losing your mind, you don't bet the farm on a setup. So, how do I think this plays out? That's the push and pull. That's the game. So, don't marry a narrative. Date it, watch it, and be ready to walk away if it stops acting right. And if you want the short, simple action step, keep your eyes on price behavior, keep your ears on macro, and use positioning as a clue, not a command. Subscribe if you want more of this kind of breakdown. And don't forget to comment our John AG if you want to support the channel. All right, that's it for today. Thanks for watching, and I'll see you in the next one. And just so we're clear, this is education and discussion, not personalized financial advice. I'm sharing how I think about markets, not telling you what to buy or sell. So make your own decisions and manage your own risk.